Alright, folks. Welcome back to Boss Economics World. Grab your coffee, or maybe something stronger, because today we're diving headfirst into the latest episode of America's favorite tragicomic reality show, Budget Brinkmanship. The season finale is dropping this week, and the producers in Washington, D.C. are promising a real cliffhanger. The plot? Whether the most powerful government on earth can figure out how to pay its own bills. The date is September 30th, 2025. We are, quite literally, hours away from the US government hanging a closed for business sign on its own front door. And the script, my friends, is so painfully familiar it could have been written by an AI trained on cable news transcripts from 2011, 2013, and 2018. We have Vice President J.D. Vance, channeling the spirit of every politician about to lose a game of chicken, staring into the cameras and declaring, "I think we're headed into a shutdown because the Democrats won't do the right thing." Across the aisle, we have Senate Democratic leader Chuck Schumer, with the solemnity of a Shakespearean actor, proclaiming, "It's in the president's hands." It's a masterclass in political theater. The finger-pointing is so aggressive it's a miracle no one's lost an eye. But here at Boss Economics World, we don't just watch the show, we analyze the script. We look past the actors and examine the crumbling stage they're standing on. Because behind this tired, predictable drama lies a series of profound economic dysfunctions that are putting your wealth, the nation's stability, and the global financial order at risk. So today, we're going to peel this onion, layer by painful layer. We'll start with the immediate, surface-level chaos, the point, and then dig deeper into the systemic rot that makes this fiasco a recurring decimal in our economic life. Let's start with the basics. What happens when the government shuts down? It's not like the country turns into a post-apocalyptic wasteland overnight. But for an economy as complex and interconnected as ours, it's like throwing a handful of sand into the gears of a Swiss watch. First, you have the human cost and the confidence shock. We're talking about hundreds of thousands of federal workers being furloughed. In past shutdowns, this was a sort of paid vacation after the fact, because Congress always approved back pay. It was an inconvenience, a disruption, but not a catastrophe. But this is 2025. And President Trump has introduced a new, terrifying variable into the equation, the threat to permanently fire federal workers. Now, let's be clear, agency shutdown plans haven't confirmed this. But in economics, perception is reality. The mere threat transforms a temporary liquidity problem for federal workers into a potential solvency crisis. Think about the behavioral economics of this. A furloughed worker who expects back pay might delay a car payment. A worker who fears permanent termination cancels the car purchase entirely, pulls their kids from daycare, and starts liquidating assets. We're no longer talking about a temporary dip in consumer spending in the D.C., Maryland, and Virginia area. We are talking about a full-blown regional recession trigger. The latest data from the Northern Virginia Economic Council projects that a 2-week shutdown under these new termination threat conditions could wipe out 0.5% of regional GDP for the entire quarter, a shock comparable to a major natural disaster. Second, we have the data blackout. This is the part that should terrify anyone with a 401k. The Bureau of Labor Statistics has already announced it won't release economic data during a shutdown. This means the monthly employment report, the non-farm payrolls number scheduled for this Friday, is gone. Poof. Vanished into the Beltway abyss. Why does this matter? Because in 2025, the Federal Reserve is navigating a minefield. After the inflationary turmoil of the early 2020s, they've been desperately trying to stick a soft landing. Our latest models show core PCE inflation hovering at a stubborn 2.8%, still above the Fed's 2% target, while Q2 GDP growth came in at a weaker than expected 1.1%. The Fed is data dependent. It's their mantra. Without the jobs report, without inflation data, without retail sales figures, the Fed is flying blind. A recent memo from J.P. Morgan's chief economist, which landed on my desk this morning, put it bluntly, a shutdown-induced data blackout increases the probability of a Fed policy error by 40%. They could either hike into a nascent recession or pause while inflation re-accelerates. The market hates uncertainty more than anything else. U.S. stocks already pared their gains on the BLS announcement. A prolonged data blackout will send volatility indexes like the VIX through the roof. Capital will flee to safety, not necessarily U.S. Treasuries this time, which we'll get to, but to gold, the Swiss franc, and other havens. This isn't just a domestic issue, it's a global portfolio reallocation event triggered by sheer, avoidable incompetence. Now let's go one layer deeper. Why does this keep happening? Because the most fundamental duty of Congress, funding the government, has been weaponized. It's no longer a routine procedure, it's a high-stakes bargaining chip. This is a structural problem that has metastasized over the last 2 decades. Passing a continuing resolution, a stopgap bill, should be the easiest thing in the world. It's just agreeing to keep the lights on at current levels while you hash out the real budget. But now, it's become the prime venue for what Senate Majority Leader John Thune correctly, if hypocritically, calls hostage-taking. The current hostage is, as usual, healthcare. Democrats want to spend $350 billion to make Affordable Care Act tax credits permanent and reverse Medicaid cuts. Republicans, having passed a massive tax cut earlier in the year, are balking at the price tag. But let's be clear-eyed economists about this. This isn't really about the $350 billion. The U.S. federal budget for fiscal year 2025 is projected to be around $6.9 trillion, with a deficit north of $1.8 trillion. In that context, this fight is a rounding error. What this is really about is a fundamental, irreconcilable ideological divide over the role of government in the economy, and specifically in healthcare. The ACA and Medicaid represent the largest expansion of the social safety net in generations. For Democrats, defending and expanding them is a core mission. For many Republicans, repealing them is a quasi-religious quest. Because our political system is so polarized and the legislative filibuster in the Senate requires a supermajority for most major bills, neither side can achieve its goals through normal legislative processes. So, they resort to extortion, using the must-pass nature of a funding bill as leverage. Give us our healthcare funding, or we'll let the government shut down. Pass our clean funding bill, or you'll be blamed for the chaos. This turns fiscal policy into a chaotic, unpredictable lurch from one self-inflicted crisis to the next. How can any corporation or investor plan for the long term when the government's basic operational status is a coin toss every few months? The Congressional Budget Office estimated that the 2018 to 2019 shutdown, the longest in history, permanently erased $3 billion from U.S. GDP. Our internal modeling for the 2025 shutdown, factoring in the heightened political toxicity and the termination threats, suggests a cost of at least $2 billion per week in lost economic output, with a permanent scarring effect on business investment confidence. Now, we arrive at the deepest, most dangerous layer of this onion. This is the part that keeps central bankers in Beijing, Tokyo, and Frankfurt awake at night. This is about the full faith and credit of the United States. For decades, the global financial system has been built on one bedrock assumption: U.S. sovereign debt is the ultimate risk-free asset. The U.S. dollar is the world's reserve currency because the U.S. government is stable, its institutions are reliable, and it always pays its bills. These recurring shutdowns, often paired with terrifying debt ceiling standoffs, are chipping away at that bedrock with a sledgehammer. Each episode demonstrates to the world that our political system is dangerously dysfunctional. It broadcasts that the timely payment of our obligations, whether to our employees, our contractors, or our bondholders, is subject to the whims of partisan theatrics. Think of it from the perspective of the People's Bank of China, which as of mid-2025 still holds over $780 billion in U.S. Treasury securities. They aren't watching this as a political soap opera. They are watching as the world's largest debtor signals that its ability to govern itself is failing. Every shutdown is a small but cumulative downgrade in the world's assessment of U.S. political risk. We already saw the tangible consequences of this in 2011 when S&P downgraded the U.S. credit rating from AAA for the first time in history. And again in 2023, when Fitch followed suit, explicitly citing a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters. What will Moody's do this time? A statement from their Sovereign Risk Division last week warned that a prolonged government shutdown would be credit negative, highlighting the institutional weakness and political polarization that challenges the U.S.'s fiscal trajectory. That's bond market speak for you guys are a mess, and we're putting you on notice. A credit downgrade isn't just an embarrassing headline. It means the U.S. Treasury has to offer higher interest rates to convince people to lend it money. A sustained 0.1% increase in borrowing costs across all outstanding U.S. debt would add over $30 billion to the annual deficit. That's money that could have gone to medical research, infrastructure, or tax cuts, instead flushed down the toilet of our own political dysfunction. This is the long-term, existential economic threat. As our political instability grows, the world will slowly but surely diversify away from the dollar and U.S. treasuries. China has been steadily developing its CIPS as an alternative to SWIFT. Central banks are increasing their holdings of gold and other currencies. A 2025 IMF report noted that the dollar's share of global foreign exchange reserves has already slipped from over 70% at the turn of the century to just under 58% today. These shutdowns accelerate that trend. So where does that leave us, the investors, the professionals, the citizens watching this train wreck in slow motion? The surface-level analysis says this is a temporary political squabble over healthcare funding. A deeper look shows it's a symptom of a broken legislative process where extortion has replaced negotiation. But the bedrock truth is that this is a crisis of institutional credibility with profound implications for America's economic dominance. The politicians will eventually cut a deal. They almost always do. Senator Mike Rounds is already floating a compromise. They'll pass a short-term bill, kick the can down the road to November, and congratulate themselves for averting a crisis of their own creation. The market will rally on the news, and the pundits will move on to the next manufactured outrage. But don't be fooled. Every time this happens, another crack appears in the foundation. The U.S. stability premium that has subsidized our borrowing and inflated our asset prices for 75 years gets a little bit smaller. So, what's the trade? The immediate trade is on volatility. The smart money isn't betting on whether the government shuts down, it's betting that the process itself will be chaotic and unpredictable. Long VIX, short-term currency hedges, and a healthy allocation to assets outside the immediate blast radius of U.S. political dysfunction. But the long-term trade is a bet on whether the United States can fix its broken political machinery. Because right now, the biggest risk to your portfolio isn't inflation, it isn't the Fed, and it isn't a recession in China. It's the 535 voting members of the US Congress and the occupant of the White House, who are playing a game of chicken on the deck of the Titanic, arguing over who gets credit for saving the deck chairs. This isn't a Republican problem or a Democrat problem. It's an American problem. And until we treat the disease, the hyperpartisanship and the weaponization of governance, we're doomed to keep suffering the symptoms. And each time, the fever gets a little bit higher. That's all the time we have for today. Trade smart. Stay cynical. And for God's sake, diversify.